Okay, I think we're okay. I'm good. And let me find my emails. There we go. Okay, so some people gave me several questions. So let's start with this. Okay, first one is a question from Judy. I am confused with the difference between a naked call, which is risky but allowed, and a naked short setting, which is illegal. They're different. Okay, so first of all, a naked call. Good evening, how are you? So a naked call is when you sell a call with no stock position. It's called an uncovered call, totally legal. Again, an uncovered, and think about it. If you're naked, you're uncovered, right? So there's no stock position. So if I have a naked call, I have a naked call, uncovered, totally legal. I have a lot of risk because it's just, I have no stock protection. I can cover it. I have a, Christina, I've done a couple options in margin. Margin, I'll think about, I'll see what I can get to. Options, I've done a few videos on it. I won't go too deep into it because that is my bread and butter on my tutoring sections. But I could probably do a little margin here for the SIE. Now, naked calls are good, meaning they're risky, they're legal, not a problem. If you want to protect your naked call, what you do is you'd buy stock to protect it. That's how you would cover your naked call. Now, the next thing is naked short selling. Naked short selling is a violation because if you're going to short stock, if you are going to short stock, you need to borrow the shares. You would need to borrow the shares before you short stock. If you try to short it without borrowing it, that's called a naked short, and it is a violation of Reg Show. So again, shorting is this. I borrow shares from someone. I then sell them like they're mine, like for 50 bucks a share. I hope they go down and I can buy them back for 40 and then give the shares back. That's shorting. I have to get a borrow first, okay? Have to get a borrow. If I do it without a borrow, it's a violation of Reg Show. Okay, I hope that helped a little bit. Let's see what else. Wow, a lot of questions from Patrick O'Rourke. Now, okay, now. Okay, so I'll start with, could you explain the ex-dividend date? And so the ex-dividend date is, and I've done this on a couple, so please, we're going to do videos, but I'm okay, but try to watch the old ones to see, because I don't mind doing it, but some people want new questions and they're watching. So ex-dividend, there's 4 dates for the dividend. Declaration, ex, record, payable. Declaration, a day we announce a dividend. Record date is a day, you're welcome, Judith, is the day you must be an owner of record to get the shares. Okay? So now, declaration, we announce it. Record is the day we must be an owner of shares, which means we have to settle by that day. And if you remember, settlement is T+2. So if I have the record date of Thursday, I must buy it by Tuesday. Okay. Tomorrow, so Tuesday, see, I read your thing and I do that. This is my ADD. So Tuesday, I buy it. That's called the Kuhn date. And if I buy it on Tuesday, Wednesday, Thursday, it settles. If I buy it on Wednesday, I settle on Friday. I'm too late. It's X. So think of X as this. Do you have a boyfriend? Do you have a girlfriend? No. Your ex-girlfriend or ex-boyfriend means you don't have a boyfriend. So ex-dividend means no dividend. So ex-dividend is always the day prior to the record date, the business day. So if the record date's Friday, it's Thursday. If the record date's Monday, it's Friday. Always the day before. Okay. 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 So I don't worry. So they're saying my first one consists of an RR collecting funds from a customer who already has an account with the firm. What will be the first thing the RR does when he collects a firm? He has to deposit it. You have to. You don't have to talk to the principal. Basically, you don't have to. He's already an account. He already has an account. Don't overthink this shit. So if I get money for, now the question is, if my customer walks in with like a suitcase full of ones and fives crinkled and bloody, yes, I have to ask him where the hell he got the money from. And if he or she has like a crazy answer, like doesn't make sense, yeah, then it's a red flag, and then they would file a SARS. Okay. Now, I think that makes sense. I hope that makes sense. If it's already a customer of yours, you should have been doing KYC already, so it shouldn't matter. A previous customer brings in funds, you have to deposit it for him, or he has to deposit it. Now, if he comes in with more than 10 grand in cash, then you have to file a CTR within 15 days. It's not a big deal. It's just a currency transaction report. If it's crazy or you see something's wrong, you do a SARS. Okay. I'm going to grab a couple of these, not all of them. Okay. Now, we'll do this. So now with bonds, okay. If you have a bond, a 5% bond, that means it pays $50 a year. Regardless of what you paid for the bond, it pays you $50 a year. So that's 5%. So if interest rates in the economy go up, your bond is still paying 5%, which makes it less attractive. So if it goes up, if interest rates go up, your bond is still paying 5%, so it's less attractive. The price will drop. So if the price drops, all the other yields go up because it's still paying 5%. Think about it this way: if it's paying $50 a year, I pay $1,000 for it. 50 out of 1,000 is 5%. But if I then have a 5% bond and I only pay $800 for it, I may be getting like 6.5%, 7% because I'm still getting $50, but I only paid $8. So as the prices go down, the yields go up. So remember, on a discount bond, it's always coupon, current, yield to maturity, yield to call, low to high. Coupon, current, yield to maturity, yield to call. Now, if it's a premium, it goes coupon, current, yield to maturity, yield to call, high to low. Now, always remember, so on a discount bond, yield to call is the highest. So if we're going to quote it, we quote the one down, we quote the worst of the two. So we're going to quote yield to maturity. If it's a premium, we always quote yield to call. Now, yield to maturity is the yield you have if you hold it till maturity. That's as much as you need to know. Yield to call is the yield if you hold it to the first call date. You do not. That's it. You don't have to do the math ever for that. The only math on bonds you'll have to do on the SIE is current yield. Yes, on the other ones, you might have to do tax equivalent yield or convertibles, stuff like that. Okay. What impacts bond prices the most? Interest rates. That's what the biggest risk, other than default, is interest rate risk. The long-term bonds move more with interest rates. So remember, long and low, baby. Long-term bonds move more than short-term bonds with interest rates. And low coupon or low price bonds move more than par or premium. That's just the way it is. Long and low. Long-term bonds move more than medium or short. Low coupon or low price move more than par or premium bonds. That's the biggest effect on bond prices, is interest rates. Okay. Okay. I've done inflation risk, and so inflation and interest rates go together. So Patrick, if you're watching this, I have a Fed policy one. Go watch that 5-minute video and then see if that helps you. So inflation risk is the fact that prices in the economy, like for your hot dogs and food, are going up every 6 months in prices, and you're still getting the same amount of money, so you have inflation risk. Interest rate risk is that interest rates rise, so your bond is less attractive, so it drops. If interest rates drop, your bond gets more attractive because it's still paying 5, and it goes up. I lost a couple on this one. Okay, so now, so also difference between Fannie Mae and Ginnie Mae, not even a big deal. They're both mortgage-backed securities. Ginnie Mae is actually an agency of the government, and it's backed by the government. Fannie Mae is not. It's a publicly traded company. They are backed by the agency and the property. Ginnie Mae is backed by the property that they're holding, the agency, and then the government. Ginnie Mae is way safer. Ginnie Mae does not have any default risk. Fannie Mae doesn't have a lot either, but Ginnie Mae has none. I hope that helps. I'm going to go to your list in a second. I'm just trying to get through the ones that, okay. Real quick, these are easy, okay? CAPM. Somebody saw quite about a question about CAPM, C-A-P-M. CAPM is the trying to manage and optimize your portfolio for risk. That goes with modern portfolio theory and all that. CAPM is basically managing, knowing that to get more return, you need to take more risk. So if you take less risk, you obviously get less of a reward. Okay. A mill rate. It's called mill rate for GO bonds. Okay. So whenever they do taxes, ad valorem taxes for GOs on assessments, what happens is that they use a mill rate. Each town has their own mill rate, and they base it on the assessed valuation. So the way I do it, it's easy, is if you have a $200,000 house, and you want to figure out what the taxes are going to be, you take off the last 3 zeros, so now you're at 200,000, chop off the last 3 zeros. Wow, that was bad. 200,000, chop off the last 3 zeros. You have 200 times the mill rate, say it's 10, 2 times 10, 200 times 10 is 2,000. That's your annual taxes. So whenever they do if they on the exam they won't do it, but on the practice ones they may ask you the mill rate stuff. So if they ask you to figure out what the taxes are, first you take the assessed valuation, not the market value. You take off the last 3 zeros and multiply times the mill rate. Boom, there's your number. Okay. Technical versus fundamental, super easy. Technical, we're looking at charts and patterns and trends and head and shoulders. We don't give a crap what the company is. I don't care about the owner, the customers, anything. No, the mill rate's probably not for SIE. Don't worry about it. So now, although to be fair, they could ask. So if it's not in the book, mill rate, I just told you how to do it. Mill rate is for evaluating how much you pay in taxes. It's probably not even on the top off, but who the hell knows? So now, sometimes they throw some test ones in there. But again, if it's one question, stressing over 1 or 2 little minor topics is not worth your time ever. Anyone on here, if you're worrying about one little tiny topic like a mill rate or this or CAPM, it's one question. Focus on the other stuff. Now, good, no stress. I don't know, smoke weed if it's allowed. So now, technical is looking at trends and patterns and the stocks and breakouts and resistance and support. We don't care about the company. Fundamental, we look at the balance sheets. We look at the balance sheets. We look at the customers. We look at the sales. We look at the revenues. We look at the debt, the assessed valuation, the profit margin. We're actually looking at this stuff. Okay. Hey, Sergio, that's awesome. I love to hear that. I love to hear when people pass these exams. I love it when they come back on. Makes me feel good. Makes you feel like I'm helping. Sergio, congratulations. Now is it the 66 or 63 after this? Okay, let's go through our list in here. Going through some useful information for hedging. All my shit's useful. But, so, hedging. This is what you need to know for the SIE and probably for the top off. If you want a deeper one, feel free to call me. Oh, I forgot to do my pitch. Subscribe. Hit the little button. Also, if you want, I'm telling you, I've been looking at the achievable stuff. Yes, and I do get a little money for that. I don't care if you use it or not. I just think it helps because it's cheap and they cover the whole SIE. It's not bad. Okay, it's like 60, 70 bucks. It's like half of a lesson with me. Okay, so now, hedging. If you're long stock, what do you want to happen? You want the stock to go up. What are you afraid is going to happen? You're afraid it's going to go down. So you buy puts. If you're long stock and you want to hedge, you buy a put. If you're long stock and you want an income, you sell a call. Write this shit down. Buy long stock, buy a put, sell a call. Those are the only options. No pun intended. Okay? Shorting stock, you want it to go down. So what do? You do bullish options. You buy a call or you sell a put. Again, long stock, buy a put, sell a call. Short stock, buy a call, sell a put. Anything more than that is more for the top off, and you may have to do questions on it, and you got to practice it. And if you want me to help you, I think I have some videos on it. If not, I think Test Geek does some stuff. Pretty sure Test Geek does okay. I don't know him, but it is what it is. Some people are saying they're okay. And trust me, I don't even know who the guy is. Okay. Okay. Limit orders. Okay, I've done these, but these are easy. Now, limit orders. If you walk in, first of all, what's a market order? A market order is when I just walk in and go buy the damn thing. Buy 100 shares. Buy 100 shares. I don't care about price. Just buy it whatever the market price is. Or sell it at the price. I don't really care about price. I'm going to buy it at the offer. Remember that. I buy at the ask or I sell at the bid. I want to buy at the bid, but I can only buy at the ask because that's where people are willing to sell it. A limit order is basically going, I want to buy stock, but I don't want to pay over a price. Like if you go into a store and you see a pair of boots and you go, my budget is $50 and the boots are 60, you're not getting them. But if they're 40, you're buying them at 40. Again, a limit order is buy 100 shares at 50. I'm willing to buy it at 50 or better, which is lower, okay? If it's a sell limit, I'm going to do sell it at 50 or higher, okay? So that's where that goes. A stop order is this, and I think I've done this before, but I'll do it again. A stop order is stock's trading at 50. I own it at 50. I'm afraid it's going to go down. What I would do is buy a put. But so now if I own stock, I'm afraid it's going to go down to like 30. So what I'll do is I'll set a sell stop at like 45. So as long as the stock is above 45, nobody even knows it's there. So once it trades down to 45, it's going to trigger and then trade on the next trade. So what happens on the next, it's going to sell on the next trade. Stock's trading at 50, you put a sell 100 shares at 45 stop. As long as it's above 45, nobody even knows it's there. Once it trades at 45, it's going to elect and then sell, okay? So it'll sell it on the next price no matter where it is, whether it's at 0, at 10, or 2,000. It's always the next price. A buy stop is placed above. So let's see about this. So sell limits are above, buy stops are above. So SLBS, slobs. Buy limits and sell stops are below. Buy limits, sell stops. So slobs over bliss. Remember, slobs are above the market, bliss are below. Prohibited trading practices, I go on forever, but a couple big ones are backing away. That's when you make a bid or a quote and you don't honor it. Front running, that's when you buy in front of a customer. Remember, customers can't front run themselves. So front running is when you buy in front of a customer. Okay. Okay. Options and margin. Christina, I did some option questions. Watch them. Again, I think Test Geek does an okay job. I don't know, but I've been hearing some people said they use them. Okay, because they can't afford my rates, so it's fine. I don't care. Now, margin. I'm not doing the whole magic. If you want a lesson, I'm happy to do it because that's my thing. But margin is leverage. You're borrowing money. Okay. Julie, not yet. On the top off, not a lot yet. So I'm telling you, they're working on it, nothing yet. So I would sit there and work for maybe look at STC or even training consultants or again, I don't want to push the guy's name. I don't know who he is, but some people said Test Geek has some good stuff on there, maybe that, and I don't think it's all that expensive. Okay. I mean, he sits on a whiteboard and draws. Okay. So I'll get you in 1 second. Okay. So now I want to fish on margin. So margin is if I were to buy 10,000 in stock, I have to deposit 5 grand. That's 50%. That means I'd borrow the other 5 grand, like a house, a mortgage. Okay. So I'd buy 10,000, I put 5, I borrow 5. So that leverages me up. So instead of only buying $5,000 worth of stock, I'm buying 10. So I can move up. Okay. Not a big fan of Kaplan right now because I think they're too deep. It's good as the good thing is if you're scoring well on Kaplan, then you're probably going to be fine because it's harder. It's a little too hard for the exam. So now, margin. Now, remember something. So this thing's called SMA. SMA is the excess equity. So if you buy stock at 10,000, you put down 5, the stock goes up to 15 grand, you now still only owe 5, but you have 10 in equity, right? Because you have your market value is 15 and your debit balance is 5, which is what you owe, you leave 10. I have a much easier way to do it, but I'm not doing it on here because I got to make some money. So now, but again, so long margin, you deposit 50%, your minimum maintenance is 25%. That means your equity cannot fall below 25% or 2 grand. You cannot start at 25%. You have to deposit 50, and then if it goes down, the market value goes down, your equity drops until it's at below 25%. Then you will have to put more money in. Or if it's below 2 grand, you have to put more money in. Shorting, you must do more. You can only short in a margin account. Again, but remember, here's a little secret. If you see debit balance, it's long. If you see credit balance, it's short. So credit balance is how much you get when you sell the shares plus your 50%. That's how much money's in the account. To get equity, you're going to take that minus the market value. There's your equity. The rest of the stuff you can kind of get. But, and again, I do a much better job in person. So now, because I don't do it this way, I do it as a whole plan. Now, shorting, I short stock. If it goes down, that's a good thing. So my equity goes up. And then if it goes up, my equity goes down. But so then if it goes below 30%, if my equity falls below 30% of the market value, I will have to put money in immediately or they flip me out. On the long side, it's 25%. On the short side, it's 30%. Now, if I buy less than $2,000 worth of stock, buy less than 2,000, I only have to put down what I bought it for. But if I short less than 2 grand, no matter what, it's a $2,000 minimum, no matter what. Okay, let's see if there's anything else on our list. Okay. Okay, options and margin. Would you want to go over hedging? Okay, we got the hedging. Okay. So again, I'm just saying, I'll touch the options real quick. Again, if you're long stock, you're going to buy a put or sell a call. Buy a put for protection, sell a call for income. Now, for break even, I'm going to give you a little trick. If you see 2 buys or 2 sells, you add the premium to the stock price. Okay? If you have stock and an option, it's always to the stock price, not the option. So if you have 2 buys or 2 sells, you add the premium to the stock price to get break even. If it's a buy and a sell, then you subtract. Your long stock, you sell a call, you're going to subtract. Your long stock, you buy a put, you're going to add. That's about as far as I can go on this. Okay. Okay, so your exam is next Friday. So look, you have over a week. You're scoring in the 80s. You're going to be fine as long as you're not memorizing answers. Okay. Okay. Oh, that's what you asked. Okay. So so let's talk about that. So if you're taking the exam and you have a question that you're not sure of, you can do what they call mark for review. Mark for review, you have to pick an answer, and then it puts it basically to the back end of the exam. So you can finish, you can do that. You can go backwards. I don't suggest going back and forth. If you don't know something, or if you don't know it, just freaking answer it, move on. You're not going to learn anything in the next hour. But if you are not sure, 50%, or you think it's really long, throw it in the vault and come back to it later. Okay? Okay, guys. Any other questions? I tried to help everyone out a little bit here. Hold on. Let me make sure that there's no more questions that somebody asked. Okay, no, that's mine. That's dividend aid. Okay, so now, again, inflation is rising, costs going up. Bonds are bad for that. Interest rates are basically tough on bonds too, because if bonds go up, prices go down. Tight money versus easy money. So what are the 4 cycles? Expansion, peak, contraction, trough, right? So expansion, the economy is moving up. We got inflation, a lot of costs going up. So we're going to tighten. The Federal Reserve monetary policy is going to tighten. They're going to sell treasuries to take money out, and they're going to sell treasuries, and they're going to raise the discount rate. During contraction, when the economy is not doing so well, they're going to ease it up. They're going to buy treasuries from the banks to give them money, and then they're going to lower the rates to make it easier to borrow. Okay. I think that was good. I kind of talked the whole time. It wasn't a lot of dead time. I think I got a lot of questions on. Again, if you want to do it again, I think I found a way to do the Notman practice exam. I don't know if you saw that in the middle of the night one time. I got I did an alert when I was trying to do a stream. I may have to just pay for one. I'm using this open source one, and it doesn't work that well. So I'm going to try it, and if I can do the Notman exam and just do it the way I did the FINRA one, that if you see my old one, where I talk through while I take the exam, I'm going to try to do that. But it's hard to stream, and especially with a work computer, because I put the stupid restrictions on because I'm the compliance guy, and now it's screwing me over. I think that works. Guys, great night. Thanks a lot for the questions. I hope I helped. And good luck. Again, follow, subscribe. If you look in my description, I have some stuff. I don't know when I'm going to do it, Judith. I've been trying for 3 days now. And if you saw, I did post at 1 in the morning. So I'm not giving a date because I don't know. It could be 2 weeks. It could be tomorrow. Whenever I figure out how to do it, I'll do it. I have it downloaded already. And since I'm not charging for it, I don't know what to do. So I'm working on it. And that's why I'm making these posts at 1 in the morning, because they get frustrated and I got to do something. The links in my description. There's some good books that may help you a little bit. Not for the 7. This is not to help you with those things. This is just if you want to see some stuff. Michael Lewis is a great author for finance stuff. His Big Short. I know you saw the movie, but the book is better. Liar's Poker is a great funny book about real estate, about our business. Michael Lewis is great. I'm just throwing my own shit in there. Anyway, listen, I'm going to go. I did about 30 minutes. See you guys next Tuesday, and I swear I'm trying to do the Notman thing. It's hard to do because I am a moron. You all have a good night, and keep reading. Don't stop reading.